Imagine you are standing at the checkout counter, watching the cashier wait while the terminal signals an error. And you can almost feel the line of customers behind you growing restless. A moment ago, you were certain your balance was more than enough, yet the card reader insists otherwise. The resulting embarrassment and confusion are familiar to millions of cardholders, and they raise a simple question that often feels anything but simple. Why does a perfectly funded account fail to authorize a perfectly ordinary transaction? Over the next several minutes, let us untangle that puzzle, traveling behind the scenes of modern payment systems, security protocols, and banking policies to understand what really happens between the swipe of a card and the appearance of an approval on the screen. To appreciate the complexity involved, start by considering the journey each transaction undertakes. At the surface, you tap or insert your card, but beneath that gesture lies a global web of communication channels connecting the merchant, the acquiring bank, the card network, and, finally, the issuing bank, the institution that holds your account and ultimately decides whether to declare approved or declined. If even one checkpoint along that chain falters, the entire payment collapses. While the network generally performs these handoffs in a fraction of a second, a single misconfigured server, an overloaded data center, or a communications outage can derail the process, leading the issuer to err on the side of caution. For the cardholder, the outcome feels personal, yet the root cause can be as impersonal as a regional network interruption hundreds of miles away. Security procedures add another layer of potential friction. Fraud remains a persistent threat, and banks deploy increasingly sophisticated algorithms to prevent unauthorized activity. These systems weigh dozens of variables in real time: the merchant's location, the size of the purchase, your recent spending pattern, past fraud statistics, emerging threat signals, even the speed at which the card is presented. When a pattern appears suspicious, perhaps a sudden international purchase, immediately after a local transaction, the algorithm may trigger an automatic decline. From the perspective of fraud prevention, a false decline is preferable to an approved fraudulent charge, but to the legitimate cardholder caught in the net, the algorithm seems capricious. Ironically, the more diligently you safeguard your account, setting alerts, limiting travel, rarely exceeding a predictable budget, the more unsettling the decline can feel when it arrives. Consider next the question of available funds versus available credit. In the consumer's mind, the account balance is decisive, yet banks maintain parallel tallies that most customers never see. Pending deposits may not clear in time to offset spending. Authorizations from hotels, car rentals, or fuel pumps can hold funds far in excess of the final bill, temporarily shrinking the spendable balance. Even if a prior hold eventually releases, the release can lag by hours or days, leaving a shadow on your limit just long enough to foil a subsequent transaction. At the moment of authorization, the issuer does not distinguish between a hold and a settled charge. It merely subtracts all outstanding authorizations from the credit limit or checking balance and assesses the residual capacity. Thus, a card can be declined despite appearing flush with funds when you log into your mobile app a few minutes later. Technical details within the physical card itself also influence acceptance. The magnetic stripe, though largely supplanted by the EMV chip and contactless antenna, still carries essential fallback data. Wear from friction, a scratch across the chip contact plate, or a minuscule solder fault in the antenna coil may not render the card completely inoperative, but it can force the terminal to attempt alternative reading methods that confuse the authorization flow. Certain merchants still rely on dated point-of-sale devices with limited firmware updates. These older terminals occasionally misinterpret a newer card's settings and respond with a decline even when the issuing bank would happily approve. In such circumstances, the same card might function perfectly in a modern grocery checkout, yet fail in a small corner cafe using legacy hardware. Geographic filters, another protective measure, sometimes clash with legitimate itineraries. Most issuers encourage cardholders to set travel notifications, but in the era of tokenized contactless payments and dynamic fraud scoring, many travelers assume such notices are obsolete. Unfortunately, some banks still flag cross border transactions aggressively, and an unannounced entry into a high risk region can provoke an instant denial. Equally, domestic geofencing may come into play if you buy fuel or merchandise in a state several hundred miles from your usual zip code only hours after purchasing breakfast at your neighborhood bakery. Banks weigh the plausibility of that distance given known modes of travel and may decline until further verification. Merchant classification conflicts add yet another wrinkle. Every merchant account carries a 4-digit category code signifying its industry, and certain codes prompt heightened scrutiny. Online gambling, cryptocurrency exchanges, and adult entertainment often require secondary verification or are outright blocked by some issuers. You might, for example, hold a card that explicitly bars cash equivalent purchases, and, to the network, a cryptocurrency exchange looks suspiciously like a digital cash transfer, even though your intention was legitimate investment. In such cases, the bank returns a decline not because you lack funds, but because the specific merchant type violates internal policy. Regulatory mandates also influence approval logic. Know Your Customer and anti-money laundering rules compel banks to track unusual patterns, particularly sudden spikes in spending. Large single purchases, think high-end electronics or jewelry, can trigger manual reviews. Even if those reviews last only minutes, the first authorization attempt during that window may produce a decline code. The cardholder typically receives no explanation in real time. Only a subsequent notification or support call reveals that extra diligence, unseen and silent, took place behind the scenes. One cannot ignore human error. A common scenario arises when new or replacement cards are issued. Forgetting to activate the card, misreading the expiration date, or mistyping the 3-digit security code online can all generate immediate denials. The bank system, built to assume certainty in those static parameters, cannot override a mismatch. Similarly, a joint account owner might inadvertently adjust account preferences, such as daily spending limits, without informing the other holders, creating an invisible ceiling that looks like arbitrary rejections until investigated. Occasionally, operational maintenance explains the mystery. Banks schedule batch processing windows during which certain services operate in restricted mode. These windows often occur overnight or during weekend hours, but time zone differences can cause them to intersect with normal shopping or dining for traveling cardholders. If the issuer's core ledger is momentarily offline for reconciliation, the authorization server may default to a conservative risk posture, resulting in temporary declines that clear once maintenance concludes. What then should the consumer do in the heat of that anxious moment at the register? The first and most practical step is to attempt a second payment method, a different card, a mobile wallet, or even cash if available. Removing immediate pressure allows for rational troubleshooting afterward. Next, contact the issuing bank promptly through the number printed on the card. Automated systems can often lift a security lock or clarify pending authorizations in minutes. While waiting, review recent activity in your banking app. Look for large pre-authorizations or identical transactions that suggest a merchant has attempted multiple times. If you are traveling, confirm whether international usage restrictions apply, and, if so, convey your itinerary to a bank representative. Long-term prevention hinges on communication and proactive habits. Keep travel notices updated where required. Ensure your contact information for fraud alerts is current. And monitor both cleared transactions and pending holds. When making large purchases, a quick call to the bank beforehand can whitelist the merchant temporarily. If you use services that issue substantial authorizations, car rentals, hotels, rideshare platforms, consider using a credit card with a higher limit to quarantine those holds from your everyday debit spending. Periodically inspect the physical condition of your card and do not hesitate to request a replacement if you observe cracks or deep scratches. Perhaps the most important mindset shift is to view a decline not as a judgment of personal solvency, but as a protective reflex of a sprawling digital infrastructure. Every false positive reminds us that beneath the surface, the financial system is balancing convenience with security, speed with prudence. While the algorithms are far from perfect, their purpose is to insulate consumers from a rapidly evolving landscape of fraud and misuse. By understanding the multifaceted reasons behind a decline, you not only reduce frustration when it happens, but also participate more intelligently in safeguarding your own financial life. The next time a terminal flashes that unwelcome red message, you will stand better equipped to interpret it. You will know that your funds may be held in limbo by a hotel deposit, that your card's chip might be sending garbled signals, or that a vigilant fraud filter has mistaken your impulsive late-night electronics spree for a hacker's joyride. And equipped with that knowledge, you will be less inclined to blame mysterious forces and more inclined to take informed, decisive action.